Welcome to the Critical Point Podcast. It's May 1st. This show is about the U.S. economy relative to PMIs. Today we got an ISM-PMI, and from another company, Market, we got their version of the PMIs, and there is a big difference. This one we're looking at Market's version, and you can find them at marketeconomics.com. And in the word market, you use an ET, not an IT, if you're trying to find it on the internet. At any rate, you can see down here, source IHS market. Now, this is the U.S. manufacturing showing a collapse in April. And notice that it's nearly as low as the 2008-2009 Great Recession. Now, PMIs run a high correlation to GDP. Therefore, they're a good clue of what's going on for the economy. So this indicator is saying the economy is as severe as the Great Recession during 2008-2009. And we did this week get the first estimate of the first quarter GDP for 2020, and it was in the minus 4% area. Big slam, it is in recession territory. And so this indicator, in terms of market, is also in recession territory. Now this next indicator takes the ISM version of U.S. manufacturing, which fell to 41.5 from 49.5 or something like that, 49.8. If you see a 45 or lower for the ISM, history teaches that we're in recession. So we got a signal from that version of ISM, but it's fascinating to me how that version of ISM is not nearly as volatile, nearly as bearish or negative or pessimistic, and I'm not sure what's holding that up. Usually ISM is more volatile than markets, so markets is just showing a complete collapse here, going into like a 2008-2009 recession, and markets is basically just saying we're just in a standard recession. Now next week we're going to get the services version of these indicators, as well as the composite, meaning a combination of manufacturing and services. I do expect the services to be weaker, and I think in the future I'll probably refocus and move from using the manufacturing so much, which I think is a leading indicator of all the PMIs, but I may want to put greater emphasis on the services since it is the largest portion of the economy. But that doesn't mean manufacturing is not important. Now, this particular indicator is a cumulative study of PMI, so when PMI is over 50, the economy is said to be growing, or at least that sector that you're looking at, meaning manufacturing or services, should be growing. Okay, I use it for the entire economy, and I believe most economists do. And that's just because it runs a high correlation to GDP. Now, when it's below 50, the economy is supposedly in contraction, or at least that sector is in contraction. The cumulative study, therefore, says simply subtract a monthly report if it's below 50 from the prior index number and add it if it's above 50. And what I've learned is this tends to reduce some of the noise and fluctuation, and we can see better the 9-year business cycle, the major long-term cycle. In other words, anything longer than a 9-year business cycle is assumed to be super cycles. And I believe in terms of our day-to-day lives, and especially for a decade, the 9-year cycle is actually more important than super cycles, even though schematic-wise, in theory, the bigger the cycle, the more important it is. But I think as far as our jobs, our careers, our finances, our investments, our lifestyle, really it's a 9-year cycle that's driving it, because the 9-year cycle is saying the economy grows for 7 to 12 years, and then you have a recession for 1 to 3 years, and it is the most important kind of recession you'll see during a decade. Normally there's just one, and normally it's the start of a recession. Now, we had 2 primary recessions last decade, or I should say during the 2000s, and that was rather rare. And one of those was linked to super cycles when we should have had a depression, but under Ben Bernanke, the Federal Reserve helped out to kind of give us confidence, and our financial system didn't collapse, okay? So we didn't get the depression, and I correctly forecast that's probably would have been the outcome. And now, of course, today, the Federal Reserve is doing much to try to keep us from falling into a depression, and you can even argue maybe that's why the ISM version of PMI is not falling that hard yet, that it's seeing some kind of support and stimulus that we're even trying to negate a recession, which is not going to work. 2020 is going to go in the history books as a recession, but I doubt it's going to go in the history books as a depression, even though some near-term data in the past 6 weeks is as bad as a depression. Anyway, let's take a look at this indicator here, this cumulative study, which I call the economy trend indicator or econ indicator. Anyways, we had a bottom and end of a recession in the early 80s, had a growth phase, boom phase, then the bust into the next recession, boom, bust, and these are about 8 to 13 years apart in time. So it's working. And then we see the Great Recession bust, which it doesn't look that serious compared to other recessions, but there's actually data showing it was the worst performance since the 1930s, and it was supposed to be relative to the super cycles. Now, this 9-year cycle, we had one of the lengthiest booms, perhaps record-setting, but still within model parameters, although it was running out of time. And then, of course, we get the virus-related recession that's pulled us down. Not as deep as in the past, but it's possible manufacturing cleaned up some things with a secondary recession in 2015, 2016, and manufacturing started to the downside ahead of the services industry and economy in general. So maybe it's worked through some of its complications and problems better than the services industry and better than the overall economy. I don't know. But I think if we flip to services, we're going to see a chart just like I showed you previously. This economy has been devastated on services and composites. Anyway, we ran some analysis here and found that if we look at these recession periods, these downside, the bust side of this 9-year cycle, and take it all the way back to 1950, that we found that basically a recession or downtrend in this indicator lasted 11 to 26 months and on average 15.8 months. Calculating from the top of last year, okay, we've come to the conclusion this downtrend and what's now a recession could end as soon as, say, July, August, but could delay all the way to October of next year. And on average, it wouldn't end to November. So who knows where the bottom's coming in, how long it's going to take. I do think the government policies, the Federal Reserve policy, the Treasury, they're all pumping money out there. I do think it's helping to stabilize, and because a virus normally is a seasonal thing, meaning you work out of it within a few months, I think there's a good chance this recession will be on the short side of time. But whether or not it can actually bottom in October is a bit questionable. I think I kind of favor towards the end of the year. But that doesn't mean the stock market can't bottom ahead of a bottom in a recession. I've noticed from looking at what the Federal Reserve calls as recessions, look at their history back to 1950s or even farther back. And what I found, and compared to the stock market, I found that quite a fair number of times the stock market bottomed at the start of a recession. Okay, and we probably started this recession in April at the very least. More likely with markets PMIs, we probably started in March. Okay, and but the point is, we were in decline. The economy was slowing down and eroding ahead of that. It started as far back in terms of manufacturing, as far back as in July of last year. I prefer to say the economy topped out in terms of pace of growth as of late 2018, and then started its contraction here, really just the start of this year. At any rate, the point is there's light at the end of the tunnel. That this year, next year, we're going to put a bottom into this recession, and we're going to start 7 to 12 years of economic growth. And there's a good chance the stock market's going to bottom ahead of that if it has not already bottomed, and it should launch a 7 to 12 year bull market, just like a forecast in our stock market long-term podcast. Have a great weekend, and thank you.